Hello and welcome to today's episode of Pivot to Profit. We are here to help entrepreneurs just like you better understand your numbers, increase your profit, and reduce your taxes. I am joined by tax guru extraordinaire, Alexis Sidney. What's up, girl?
Hey Pam, how's it going?
Good, good, good. We are in the heat of tax season, so I know you are loving your life and career choices right now.
I am. Every time it's tax season, I'm like, gosh, what is a fun business where I could just like show up to work with a mocktail on the beach?
I understand. I understand. Today, we're going to dive into entity structures. But before we do, want to say, hey, business owner, if you are stressed at tax time, if you have no idea what your numbers are, or you get a surprise tax bill that you didn't know was coming, we would love at Pivot Business Group to help you understand your numbers, get your profit in the right direction, make sure you have a strong tax strategy, you're complying with the IRS, but you are keeping more than you are giving away. Simply go to pamjordan.com to book a call with our team. All right, Alexis. So, big thing that we're going to talk about is entity types. And so, what we mean by this is the business structure. And what people don't understand is that there's a legal structure to your business and a tax structure to their business. And so, you and I, through our process, we do analysis and we talk to people like, oh, well, I'm this. And they don't understand that your business is actually two things. So help us and our listeners understand what it means between your legal structure and your tax structure.
Yes, great way to start the conversation. Oftentimes, a lot of times business owners they'll just say, hey, I'm a S Corp or I need to be a S Corp. And I'm like, okay. But we'll say you're a LLC and they're like, no, but I need to change to be an S Corp. And I'm like, okay, yes, we need to figure that out. So what we need to understand is that all businesses have a legal structure, as Pam just mentioned. The legal structure is determined on your state level. So as you know, all states have Secretary of States where you go register to become an Inc. or an LLC or, whatever you decide, nonprofit partnership, whatever. You have a legal structure and that lives at the state level. Every year, and I think it's time now, Georgia, just
April
sent out
15th.
notifications that you need to go ahead and update it because they will dissolve you and you will not have a legal structure. So that's another conversation. But definitely you must maintain that. So where the S Corp comes in or the C Corp comes in, that is a tax election status. So there's two things that's handled by the IRS. So when it's time, and we'll talk about that in our conversation today, when it's time to check on that S Corp box or it's time to become a C Corp, we will work with the IRS to file some special paperwork to say, hey, I want to be taxed as an S Corp or a C Corp, but you will always be an Inc. or an LLC because you keep that on the state level. So that's the difference between the two, being a legal structure and electing to be treated favorable by the IRS as a tax status.
Yes, 100%. And so, entrepreneur, you need to understand how you are set up and the benefits and the disadvantages of each. And the answer is when people come and ask us, which one should I be? The answer is,
it depends.
Thank you, Alexis. That's right. It depends. That should be the title of our episodes. It depends. Because look, y'all, it depends on what your goals are. It depends on what you want this business to be when it grows up. It depends on where you live because there's some states where taxes suck more than other states. And so you need to understand, do you have a partner? Do you want to sell it? Do you want to retire? What are all those look like? So it's really important for you to understand what you have now. And is it helping or hurting you? And a lot of times when people come into our ecosystem, Alexis looks at what they have and she's like, okay, well, we need to change this and turn that off. And we need to open one of these. And so a lot of times our clients, when they come to us, the answer is we need to either change what you have or add to it. I personally have, I think 5 or 6. I just opened another one. So I think it's 6 companies. And they are not all the same legal and tax structure. And they're not even formed in the same state. So look, businesses are fun, but you need to understand the benefits and the disadvantages of each. So, Alexis, why don't you give us a quick tax tip when it comes to entity structures to start us off?
Well, definitely a quick tip, like Pam just said, is really having a conversation with the professionals, us, to really determine like what are your goals and what are you trying to do here. I see a lot of times where people just open up massive LLCs, and I'm like, you're doing the same thing. What is going on? Oh, well, I got to have all this stuff, and I'm like, no. So a tip: just really speak with a professional. Understand your goals so that we can map out a plan. It's easy to start with something clean with less, businesses and kind of start with one operation that can hold, multiple entities or different activities, versus all this massive, paperwork and filings and annual registration fees and tax returns. And it gets costly. And it's like, that wasn't even necessary. So that's my tip.
I love it. We have a client right now that we're working with that got advice from someone else, not a tax professional, and have multiple entities, multiple different kinds, and like we're trying to help them break it down because the number of tax returns they have to file is excessive just because of the structures they have, because the person they took advice from didn't understand their overall goals. So they're actually, I think there's 3 entities that have to have a business return just because of the way that they're structured, when in fact, they're not actually operating businesses. So I'm like, I'm super sorry that I have to charge you for those tax returns, but whoever you listened to was an idiot, but we can fix it. Love you.
It'll be better next year, right?
Yes. Good news is tax returns for 25 are going to be less. I love it. I love it. So from the profit side of things, my side of the fence, what I want you as an entrepreneur to understand is your business structure and your tax structure could be costing you money. And by what I mean is, one of the things that we identify is your entity type. It's either the right one for you and your goals, or it's the wrong one because you're overpaying on taxes. For example, if you're a sole proprietor, you are paying 15% more than if you have an S corporation, a C corporation, or an S election. And we can go into what all that means. But if you have the wrong structure, it is costing you money, and you need to be aware of that and make changes so that you can put more money into your pocket. So make sure that you are talking to intelligent people that are telling you what to do. When it comes to deciding what entity structure a business owner should take, both on the legal side and the tax side, Alexis, what questions should they be able to answer? What do they need to know to be able to choose the right one? Because it depends is the answer.
Yeah, it definitely depends. I always like to just get a feel for what is this business going to be like. Just start in small scale. Like, I don't even want to take it 5 years, but hey, what are we planning to do this year? Like, we can make all the money in the world. That's great. We can be a 7-figure business, but we can have a 100K loss. And it's like, hey, stay a sole prop or a regular LLC because you're not profitable. So we start there because the profit matters, because that's really what drives the strategy and really the conversation of, hey, if we are just a regular sole prop or an LLC, depending on where we expect to end net profit wise at the end of the year, is how we want to, restructure or consider turning on the S Corp or the C Corp status. So I definitely look at the numbers, they matter. And then from that point, if we do have a profitable business and it's like, hey, there's some opportunity here for some tax savings and some strategies, now I dig deeper because I want to know the makeup of the company, and like, hey, there are certain strategies that, apply to C Corp businesses. And like, if they're a big, like, charitable giver through the business, a lot of times I always see it. It's not funny, but it's funny to me because clients will create their own tax strategy. And it's like, hey, you go look at the books and it's like they gave $50,000 away in charity through the business and their S Corp. And I'm like, okay, I'm all for charity. I love giving money away, especially to a cause. But that gets added back. That is not reducing your net profit. And they're like, what? What is going on? And so I'm like, no, sorry, that it doesn't work that way. But had we had a conversation, we would know, like, hey, what are you doing? What are your goals? What are some of those activities and things that are passion projects or just things you plan to operate within the business? And we can strategically say, hey, if you're going to do this, let's do it this way. Let's, turn this, because if you was a C Corp, that will be deductible dollar for dollar through the corporation and you will get your deductions versus for the S Corp, it goes to your regular 1040 and you can write it off there if it matters, depending on that's a whole nother conversation. So it's just little things like that that we just really need to understand because each client situation is different. Of course, you get to a point where, like, I've had a client and you're making millions of dollars net profit, and it's like, hey, I'm going to take all of that and transfer it back to my personal tax return to get taxed. And it's making you in this ginormous tax bracket where it makes sense to just keep it on the corporate side and get flat tax at 21% tax rate. Like, that's where those conversations start happening. And we just need to understand the makeup of your overall business goals, the plans. What is the year end going to look like? And then we could determine, hey, let's turn on this, let's turn this off, let's set this up, and we can just figure it out that way.
I love it. What is your opinion and thoughts on where people set up their legal entities with the state? Like, do you need to do it where you live? People talk about they love Delaware, they love Wyoming, Florida's fun. Like, what is your thought about where people set up their entity?
It really depends on like the level of your business. I think a lot of times, people are on TikTok and, they hear a lot of the gurus saying, hey, I'm going to Wyoming. I'm going to Nevada. I'm going to set my business up there because, in their head, they don't have any state taxes. And I'm like, okay. If you live in Georgia and your business is set up in Nevada, you still are subject to the taxes here. So it's like, who told you that? You don't get out of not paying taxes on the income. So that's that. But there are cases where for protection and asset planning, as you want to dive into, a different level of conversation where you got assets you want to protect and trust, a lot of times people decide, hey, let me go to some of these favorable states because there is a thing called, I say it wrong, immunity. I'm going to say it slow.
I love it.
Where the person, like, let's just say someone was trying to find you because you're registered in that state, you're not actually registered and they cannot find you. So that's a whole nother level of planning where you get strategic and you say, hey, I'm going to Nevada, Delaware, or those states where they have that feature. But if you're just a general business owner, like I'm a general business owner, I'm not like a billionaire yet, but when I get there, I'll restructure my stuff.
Yeah.
But I'm registered in my state and, you can go look me up at the Secretary of State. So it just, like I said, depends on what your goals are and what you're truly working with. To say, hey, I'm going to go here versus registering here in this state and play that game.
Yeah.
So just depends.
Yeah. Yeah, I agree. What I've found is if people are going to potentially need to do like or a series raise or they want to go public, there's states that are definitely more advantageous for that. But the average business owner, you can register in Wyoming or Delaware, but you're still going to have to pay taxes where you live. And California, it doesn't matter. Like, they're going to get you. So Massachusetts, Connecticut, like Maryland are bad. Like, just know that you are not escaping things by having a registered entity in another state. Like, there's some protections that it brings, but you're still going to pay the tax man. All right. So let's dive into the entity structure. So a sole proprietor or sole prop is the base level that most people who start a business, they hang their shingle and say, I am now a landscaper. Look at me. I'm going to go get some clients. And they are a sole proprietor. So what does that mean? What are some pros? What are some cons there?
Well, definitely being a sole proprietor is pretty much our entry level. You don't have to register with the state. You don't have to get an EIN number. You could just say, hey, I'm Alexis. I done started this bakery shop, which you probably need some license for that. But you could just say, hey, I'm Alexis, Alexis Cupcakes, no legal setup, no nothing. But the risk with it is that you are personally tied to the business. So if something was to happen, you have no legal protection, there's no separation. So if you have a nice house, car, money in the bank account, and something happened with those treats you gave someone and they got sick, they can come after you and take everything. So again, it's real easy to get started with. Again, you really don't have to do much. Just say, hey, I'm starting my business and operate in that way. But as you start to expand, you definitely want the protection, which goes to being a LLC, a limited liability company, and that's pretty common amongst pretty much all business owners. A lot of them typically go that route versus the incorporated, Inc.
Yeah.
But definitely with the LLC, you do get protection, which is good. So there is a separation. So there's a separation between the personal and the business. So you're protected. So if some crazy person came back and say, hey, I got sick off of your treats, can't touch my personal stuff. The business got nothing. Sorry. I got insurance.
Good luck.
Yeah, good luck. So it's good to operate that way, definitely having the protection there. And again, like we said earlier, that is at the state level. One of the things with it, you are taxed at 15.3% self-employment tax on all your income.
As an LLC.
Yes. So whatever your math is mathing, 15.3%, that's what you're paying in taxes on the tax return. So keep that in mind. However, another thing is that you cannot be an employee of your company as an LLC. Okay. So I see a lot of slicksters sometimes trying to say, hey, I paid myself this and think it's a deduction. It's not a deduction. I'm sorry.
Nope. An LLC, the owner cannot be on payroll. Let me just be really clear. There's ways around it, but unless you have the proper paperwork, an LLC, the owner cannot be on payroll.
Right. Right. And not, yeah, correct. So that's the downfall to it. But like I said, it does open the doors, like your foundation to decide, hey, do I turn on the S Corp or do I want to be a C Corp? You have to have that LLC to do either. You can't just say, hey, I have nothing and think you can go elect to be a S Corp or a C Corp. So when we go to the next level, which is typically the S Corp for most business owners, I have a little math formula that I like to use. Everybody has their own thing, but definitely for clients that I work with, if you don't have like a net profit of about 40 to 50K, sometimes 60, I don't even like entertain doing the S Corp. You definitely want to be profitable to a certain level before you turn it on. And I say that because it's costly. You definitely you are required to take a reasonable salary. You are required to be on payroll. As we know, payroll comes with responsibility. You got payroll taxes. You got to pay the payroll people, the system, everything. So it's extra stuff that you need to do. You need to file an extra tax return. A lot of people complain about the regular one.
So what you're saying is if you're an S Corp, the S Corp needs to file a tax return, and then you personally need to file a tax return. So just be aware that and that's a different deadline as well. That's March 15th for the business and April 15th for personal. So just be aware that as you change your entity type and you go up essentially the ladder of entity structures, there's more cost involved. So you're right, Alexis, 100%. We deal with clients, they come to us and they're like, are we ready to change? We look at their numbers. You don't have enough profit. It's not worth the expense. Or, oh, dang, you should have been an S Corp 9 months ago because now you got to pay 15.3% on that $200,000. Sorry, let's fix it going forward.
Right. And then another thing to keep in mind as well, in addition to the tax returns and in addition to the payroll requirements, you definitely need some books. And I'm not just talking a spreadsheet. I'm talking QuickBooks, you need financial reports, you need a profit and loss, you need a balance sheet. And I say that that's important because that information needs to go on to that S Corp tax return. And while there are some exclusions, if you made under a certain amount, there's no balance sheet requirement and, all of that stuff. But at the same time, like we need that data as professionals. And I don't want to have to go creating a balance sheet and figuring that stuff out for you. So there is a lot of upfront things that you need to do. A lot of it, let's just say S Corps are high maintenance, like, me, I'd like to be high maintenance.
I love it. That's a good way to put it. S Corps are
Requirement.
high maintenance. That's a quote for the podcast. I love it.
So high maintenance, a lot of stuff you need to do to maintain it, and it may not be worth it for some people. So in that case, just stay being a LLC. But I love S Corps because there's a lot of strategy. Once you become an employee of the company, that's when I get to do my jam and start
Yes.
out tax strategies, hiring kids and accountable, all that great stuff that helps you, legally save money. And then we get to turn on the door to advanced strategies if well needed. So you have a lot of, game for opportunity being an S Corp. So definitely, if it makes sense, we always do the math for you so you can see up front and not just follow TikTok and be like, everybody gets an S Corp today. We're setting up S Corps. So definitely strategy behind it. So just understand the strategy before you decide to turn it on to make sure it makes sense for you. You understand all your requirements, what you need to do so that you can maintain it in the proper manner.
Yes. And make sure that if you're wondering, like, is it time? Have an intelligent conversation with a tax strategist or a tax attorney. Make sure they understand what your goals are before you make the switch. Because once you make the switch, that's what you are now. And there are lots of tax strategies and advantage of each of these. But a lot of our clients sit really pretty at the S Corp level and save a lot of money and make a lot of money, put more money into their pockets tax free. Right. So understand that freedom comes and more wealth comes with the right entity structure. So let's shift into C Corp because that one is for me the most confusing because most people don't have C Corps. And there's double taxation and all of that. So help us understand why people have C Corps and who they're right for.
Well, definitely. I definitely feel like C Corp is more of a strategy or a scalable type of company. If you know that, in the future, you're looking for like investors or different things to that nature, it may be a good thing to set up a C Corp because they're attracted to C corporations. You can issue stocks, you can do some large scalable things on a C Corp level that is not advantageous on an S Corp level. Keep in mind that with S Corps, not to get too technical, but you're limited to 100 US shareholders, so the IRS has guidelines on that. But with a C Corp, you can have international you can have anyone can be a part of the C Corp. You're not limited to 100 people. Can you imagine like Microsoft being limited to only 100 like shareholders?
No,
Like,
that would not work.
so awesome. So that's why we have the C Corp. It's like turning the game up to a whole nother level with no limitations. So, if you're feeling like your company is going to grow and scale towards that, you can even start as an S Corp and then decide, hey, it's time to restructure and change over. And as you progress, we can switch that on. But definitely, one of the things like with C Corps, like I said, from a tax strategy standpoint, there's a lot of more things we can do that's more advantageous. When it comes to like clients, again, it makes sense at certain times where, again, if you are S Corp, and like I mentioned, I had a client or have a client where their net profit was in the millions. And we did all the strategy we can, for that year. And, there's possibly some more stuff, but it just made sense to say, why are we transferring all of this money back to your personal return to put you in the highest bracket of like 35% to be taxed on, where we can save a portion of that by keeping it on this level and just pay the 21% taxes? Like, and
It's
let
better
your
than 35 on
right
millions of dollars.
get a refund on that. Like it just makes sense. So you have to do the math. Now, one of the things that everyone always say is the double taxation. So I'm gonna break that down because what happens is that hey, as the business, you pay corporate taxes on the profits. So let's just say you had profits of $100,000. You're going to pay 21% on that flat tax rate. But what happens also is now as the company, owner, if you want to take money from that profit, you'll get a dividend. You can take all the money you want, but now you're going to get a dividend. You're going to pay tax again on that money when you put that dividend on your tax return as a form of payment, and you're going to get taxed again on it. So that's the double taxation part. For some people, it's like, I don't care. It is what it is. But for some people, it's like, nah, it makes sense to just be an S Corp because once you pay the taxes on that, you can take the money because you've already paid the taxes and there's no double taxation. So again, it just really depends on the game you're playing. Once you're ready to get to that C Corp level, you definitely want to have a strategy in place so it makes sense to you and like, hey, I'm doing the right thing. If you're one for constantly taking out money out the company, is like this may not be the fit for you because
Right. Yes. And so what's amazing is when we work with entrepreneurs, part of our process is to assess what they have and make a recommendation on what would be the best for them and based on their goals and asset protection and tax strategy as well. And we find that a lot of entrepreneurs don't even know what they are and then don't even know what the requirements are. Like Alexis and I will meet with entrepreneurs and they'll come to us and they're an S Corp and they've been filing S Corp tax returns, but they're not on payroll. That is a requirement of an S Corp. You have to be on payroll. And there is a cost associated with payroll, whether you use Gusto or ADP or whatever payroll provider. But if you're an S Corp, make sure you're on payroll. And if you're an LLC, don't be on payroll unless you have an S election. So let's talk about that for a hot minute because it gets confusing. Because I think the confusing part is it's the same words.
Yeah.
And so people are like, oh, well, I'm an S Corp. Okay. Or I'm an LLC. Okay. But you can also, just to be clear, you can be an LLC, limited liability corporation, legal structure with an S election for taxes.
Yeah.
Explain what that means.
Yeah. So again, going back to earlier, like the entity LLC lives with the state. So that's just protecting you. But the S Corp is a tax status. Like we're going to the IRS and saying, hey, Mr. IRS, I want favorable tax treatment. I'm filling out this S Corp paperwork and you're going to grant this approval for me so that I can get all the special tax treatments and take advantage of tax strategy. Thank you very much. Here's your approval letter. So we have to look at it that way to know like there is a difference. And once you elect that, once the IRS is like, here's your approval letter, your certification, if you want to call it that, you have to go get your behind on some payroll.
Let's go.
Too. One thing that we didn't talk about, which I see happen a lot, is that you have people that form these partnerships, so
Yes.
me, you, or whomever, we have a partnership. And the partnership can be an LLC partnership, or it can just be a joint venture partnership, or, two companies. It can get tricky with partnerships. But a lot of times I'll see partners are on payroll. And there should not be. And that's another no-no that I see, is that they'll be on payroll and writing salaries off and things of that nature. And that shouldn't be the case. You get you can do guaranteed partner payments. That's a conversation for another day, but you should not be on payroll. Your employees can be on payroll, but not you. So we have to back that out sometimes and fix that and clean that up as well. So just understanding, if you're a S Corp or if you're a part of a C corporation, payroll, you get on payroll, pay yourself. But if you're a sole proprietor or if you're a regular LLC with no favorable tax treatment from the IRS, you are not supposed to be on payroll because you're not an employee of the company. You're an owner.
Yes. And another thing is These are all US tax business structures. But what if someone who is Canadian, they can't just be any of these? Because you're, correct me if I'm wrong, but like an S Corp, you need to be a US citizen, correct?
Yeah, you should be a US citizen. Now, certain times they'll allow companies, depending on the type of company, to be a part of the shareholder. So there's some layers to that. If you have a green card, you have the opportunity to, kind of ease your way into the S Corp, shareholder bucket. But the IRS is very strict on who can be a part of the bucket. So you definitely just want to, consult with, a professional to make sure like you're not crossing any lines, or if you're kind of on the edge, like make sure it's solid.
Yeah. Yeah.
um, because you don't want it to be revoked and then you have to go and fix it. That could be a whole mess in itself.
And then
Nobody
you've
wants
got to
that.
redo tax returns and all that.
Yeah.
So I think some key takeaways for our listeners here is, one is understand what you are now and the pros and cons of it. And then look at what your goals are and what your profits are to determine, can you stay what you are, or is it time to change? And sometimes the answer is change the entity that you currently are operating in. And sometimes the answer is to add another entity, add another layer. So do that process and then understand what makes sense for you, and then go talk to a tax strategist, talk to a tax attorney, and make sure that the move that you're about to make makes the most sense. Because unwinding it, like Alexis says, is costly and damaging and time consuming. Because I don't know how many of you have ever tried to call the IRS, but it is an hours long conversation. And then you get disconnected and you're waiting for a letter back and they want you to fax something in. Look, y'all, I don't even know where a fax machine is right now. So, like, understand what you have, understand what your goals and what your profits are, and then go have an intelligent conversation with someone about what makes the most sense for you based on those goals and based on your profit and based on where you're going next. And being a sole proprietor is fine while you playing, but once you're actually doing this game of business, get yourself out and play a different game.
Definitely. Protect
Uh,
yourself.
Protect yourself. All right, Alexis, any final words of wisdom for us about entity structure and taxes?
No, I think you hit the nail on the head. But like I said, just definitely have a game plan. Stay off of TikTok, getting your advice there. Definitely, whenever you try to or want to make a change, just make sure you know the numbers and how that's going to plan out for taxes, and not just go with the hype of, yeah, I'm doing this because this is what everybody's talking about. This is what's trending today. How about that?
Yes, I love it. Yeah, I was scrolling Instagram reels and some lady was talking all about Delaware, and I watched the video and I was like, but I live in North Carolina, so that doesn't matter for me. Thanks though. So it's just so funny. Like, don't just trust the gurus out there. Have an intelligent one-on-one conversation, because I understand there's some cost involved with that, but it will save you money in the long run to have the right entity structure. We've had clients where we've saved them tens of thousands of dollars in taxes just in 1 year by changing their entity structure. So make sure you have intelligent conversations. All right, Alexis, that is all for today. I love it. Hopefully this has been helpful for y'all. Please subscribe on Apple Podcasts, YouTube, or wherever you listen. And remember, it is not what you make, it's what you keep. Thank you so much for listening to today's episode of Pivot to Profit. Just go to pamjordan.com to schedule a call with our team if you want us to have that conversation with you. Thank you so much.